Good evening and good morning or whatever time of day it is. Uh, I'm going to try not to be distracted by this, which is my Robinhood account blowing up right now. It's looking like a good day so far. I am going to talk about options, what they are, and how to trade them on Robinhood. And hopefully, I can be not distracted and get something accomplished here. So I'm going to open up Comcast because that is a good one to use as an example. There she is. Okay, so the Comcast page, if you know about Robinhood, you kind of know what is going on here. And if you don't know about Robinhood, refer to one of my earlier videos that talks about like introduction to Robinhood or something. I don't know. But this is where you would do your traditional investing. You'd buy shares or you'd invest in dollars. Order down here. But if you go under that, there is trade options. And this is just the ticker for Comcast. It's the same place on the phone. It'll say like trade Comcast or something like that, and then you just basically click until you see something that says options or tap whatever. And then you'll get to this page if you do tap on it, and this looks pretty much identical to how it looks on your phone if you're doing it for mobile as well. So up at the top it's got Comcast. This tells you we are in the Comcast stock, and that's what we're looking at for share prices to buy an option for or to sell an option, but I'm just going to be talking about buying right now, and probably just call options because it gets really complicated really quick, and it can get way more complicated when you start adding layers like selling options and buying put options. So for now we're looking at buy call for Comcast. If I were to click on sell, it would go to sell call and say that up there. So that's one indicator on what you're doing, because you don't want to be thinking you're buying and end up selling, or thinking you're buying a call and end up buying a put. That would be bad news. So up here, for again, I'm talking about buying a call, you're going to want buy selected and call selected. And then I will stop there to talk about what an option is, because that's important when you look at expiration dates here. So an option is a contract. It is not the same as buying stock. You are buying a contract which gives you the right to buy a stock at a specific price. And that price is called the strike price, which you can see here. So all of these are options that I could buy. There are many options for options when it comes to call options for Comcast. So I would find the one I like. Again, a call option is you're assuming the price is going to be going up prior to the expiration date, ideally, within that time frame, or immediately. Either way, you're assuming the price will be going up. If you were in put options, you're assuming the price is going down. But today I will just be talking about call options to keep things simple. So up here is your expiration date, because again, you're buying a contract, you're not buying stock necessarily. So your contract will expire. You can pick when it expires, but the farther out you go, the more expensive the prices are going to be for your options. Excuse me. And the numbers are a little harder to get to sometimes. But if you've got a good trajectory and you know the stock really well and you believe it's going to go to a certain place, then by all means pick a different expiration date. One thing you never want to do is if it was February 3rd, you don't want to buy something expiring February 5th unless you're like 99% sure that it's going to either blow up or nosedive, whether it's a call option or a put option, like immediately. Because you can run into trouble really quick otherwise and lose a lot of money. So, for the sake of keeping it simple, for the sake of simplicity, we're going to look at this $50 strike price because it's got a nice even number here of $2, and we can work with that $50 number pretty easily. So let's say this is the one I've got my heart set on. I'm going to click this little plus button over here, icon, whatever, and then I'm going to hit continue. So like I said, an option is a contract. So when you go over here, it says long call. Again, long versus short. Long is you think it's going to go up. Short is you think it's going to go down. So that's just what that means. Every contract is for 100 shares. So I type in 1 here because I just want to buy one contract. It's going to be a minimum of 100 shares is what you're looking at. So it's set to $2. I'm going to type it in because you can technically put different numbers in here because you're bidding for this contract. But you pretty much, if you want to get it right away, you'll want to put the number that they give you for the price over here on the right. So expires, this is not talking about the contract expiring, this is your order expiring, just like if you put in a limit order. So it's kind of a good idea to keep it on good for the day. So whatever day that you're putting the order in, then it's just going to expire at the end of that day. If you're not able to make the purchase, if your bid isn't good enough for the strike price that you're looking for, then that order will just expire and go away and you won't lose your money here. But if you put it in to not expire, be good till you manually cancel it. It could sit there a couple days. The problem with that is the market fluctuates, and if 2 days from now the whole stock tanks or it blows up, it's going to change the value of this stuff by a lot. So if it tanks and you're willing to pay this much for it, but it's only worth half of that 2 days from now, if you still got your order in, it's going to buy it anyways, and you're going to automatically lose money right out of the gate. So it's a good idea to keep it your order for expiring just at the end of the trading day. So good for day is a good way to do things. So that being said, how do you make money? How do you lose money with an option? Your break-even price right here. This is the number. Well, let me back up. So expiring. This says expires February 5th. If you hold on to the option until the point that it expires, what happens is one of two things. Either if you have enough money in your Robinhood account, which for $50 per share at 100 shares, you would be buying 100 shares of Comcast at this price. And it's irrelevant of what the actual value of the Comcast shares are at that point. Your contract says you have the right to buy it at this price. You have the obligation to buy it at that price, I should say. So if this is way up to $60, you're getting those $60 stocks at the discounted price of $50. But you already paid $2 per share to even have that option in the first place. So what you need to break even is you need Comcast to be up to $52 per share price for you to break even on this contract. And then anything above that is profit, but anything below that is loss. And that is if you hold on to it until it expires. So if you have enough money in your Robinhood account, it will automatically buy your 100 shares at your strike price, and then you'll have those shares to do with what you want. If you want to sell them for the value it's actually worth, and it's in the profit, then you'll sell it and make your profit. If you want to hold on to them, you can hold on to them. Or if you sell them and it's actually the value's gone down, you're basically overpaid for them, but you can still hold on to them, and maybe they'll get back up to 52 and you'll still break even. But that's if you let it expire. If you don't let it expire, whatever the value of that $2 contract was is what you're going to be able to sell. Like, it starts out at this price when Comcast is at this dollar amount, but if Comcast goes up a little, the value of your contract might go up a little because people are assuming that the price is going to go up over the $52 and they'll get into the profit. So what that looks like is with this is an option I have here. It's a call for Ideanomics, I bought it when it was 99 cents per share, but it was $99 because it's 100 shares per contract. So I bought this contract for $99. Right now it's worth $97. You can see that number right up here. But I just bought it today, so I'm hoping, because mine expires the 19th of next month, I'm hoping the value of this will go up and I will be able to sell it. And I think I actually put the order in for this. Doesn't look like I did. So I'm going to do that now. And it'll show you what you would do if you were doing what I am. So since I have one contract is all I have, it's +1 right there. I am looking to sell to close. And then for the limit price, I'm going to put in what I would be willing to, the lowest amount of money I would be willing to accept for my contract. Which for me, if I can get a 20% profit on my almost $100 and get 120 for it, then I'm good with that. So I'm going to submit that order, and then I might revisit that before the 19th. If it's looking like it's not going to do that, I might stop a loss or settle for less money. But that's how you can get out of your options trade, because it is a contract. You are obligated at the end of the contract to fulfill the contract unless you sell your contract to somebody else, and then they'll be obligated until they pass it on, and so on and so on. So going back to Comcast, for this $50 one that we talked about, that we're looking to buy for $2 per share for $200 total, I made a spreadsheet real quick just to kind of show what that could look like. And then this will also talk about how kind of where the risk is and also leverage for this. So this is if you let the contract go to the point of fulfillment and you decided to fulfill your contract. If the actual price of Comcast when you go to fulfill it is $55. So this, again, it expires February 5th. So you have until the 5th to figure out if you want to sell it, what you want to do with it. But if it expires on the 5th and your price of Comcast, the actual price goes up to $55, on 100 shares, you're up $500. But because you paid $200 for the contract, you'll lose that initial $200, so your total net would be $300. And you paid, again, $200, and that would be a return of 150%. But that's pretty high. What might be more realistic would be like 53.5, right? So you at 53.5, your $3.50 times 100 shares is $350, but again you have to take out that $200, so maybe you'll make $150, which is still a great return. You make $150 profit when you put in $200 on a bet. Again, betting on Comcast prices to rise. If it only goes up to $53, you're still making $100, which is a 50% return. If it goes up to 52.5, you still make $50 profit, which is a 25% return on your $200 that you put in. So that's where you can make a lot of money, is because it's leveraged like that, because it's based on 100 shares. And same thing, your price will, if your actual price is going up, your contract, your option, if you want to sell it, is going to be going up with it. That's one thing I didn't point out here. I'm going to open, it's Ideanomics. This is the stock that I have the contract in. This option, this call option is for that stock. So I'm going to open that stock on the next page and show you. Since it's expiring the 19th, that's a ways out, the charts here are almost in line with each other as far as the value. So as the value of Ideanomics has kind of went up and down for the day, so has the value of my option. Now, once you get towards the end of the expiration date, your value of your option is going to start dropping exponentially. And that's because people might as well just buy the stock at that point. They're not as interested in the option unless the option is really, really either, if it's a call option and it's really breaking out really high at the end of that, then yes, it might be worth more. But or if it's a put option and it's really tanking, it might be worth more. But if it's kind of bouncing out, or even if it's going up but not a ton, your value might still go down on the contract, because they might as well just buy the share at that point, or the stock itself outright. So let's talk about if you lose money, because this is where you can lose a lot of money. If you're wrong on your option, and let's say it goes down to $48. Sorry, let's type that correctly. Let's say it goes down to 48. Hit enter. Your net's going to go way down. So you're only down $2, right, per share. So that's negative 200, because you got 100 shares. But then you have another 200 that you're losing because of how much the option cost in the first place. So not only do you have to pay for the contract, but you also have to pay for your 200 that you're down if you sell it. But either way, you're gonna have to pay for that. So that's where, if you're wrong on options, you can lose a good chunk of money. This is where most people will say, and I will do this as well, to put a stop loss on it. So what you could do over here, which I can't on that one because I've already got it going, but on option it is just like a share, where you can set it to sell if it hits a certain point or gets below a certain point. Just like, let's pull up one of my stocks. That is distracting me right now. Yeah, I'm having a pretty good day on Robinhood. So I'm going to pull up SPY, for example. If I wanted to sell SPY, it'd be the same thing, except it'd be on your option page. It'd be sell to close, and then you'd put in the number that you want to sell it at or whatever. So that's basically it for this video. I didn't want to get into put options or selling options because it adds a lot to it, and it's already kind of complicated to figure out just buying call options. So hopefully that brought some knowledge to you. If you have questions or whatever, I'll probably make other videos to cover the rest of the options, or maybe one longer video later. But that's it for now. So thanks for watching. Hope it made sense. If it didn't, let me know. And yeah, hopefully I'll be able to answer questions if there are any. Thanks.